Very good morning, students. One thing candidates often tells after exam is I was expecting more practicals, but a lot of theory came and all those things. And especially conceptual framework is one of the topics which is frequently asked, especially in a question 5. And what happens is you would have studied maybe 1 month back, 2 weeks back, and all those things, but you'll be finding it difficult to recall. So to overcome all those things, I've shared few things from conceptual framework, which is going to be very handy for you. So pay full attention within 5 to 10 minutes. It will get registered in your deeper mind and keep on recalling on exam day morning also. So first one is, what are the limitations of general purpose financial reporting? It was asked in a May 2025 exam. They do not, that is general purpose financial reporting, do not and cannot provide all the information that in this question the catch term is existing and potential investors. It is asked, this term is used repeatedly in this. So this is the, I mean, they cannot provide all the information that existing and potential investors, lenders, and other creditors need. They need to consider other information, for example pertinent sources, pertinent information from various other sources like political events, and where, for example, the ongoing Iran war, you need to check the news, Twitter updates, and all those things. And general purpose financial reporting are not designed to show the value of a reporting entity. They provide information to help existing and potential investors, lenders, and other creditors to estimate, I repeat, to estimate the value of reporting entity. And lastly, they are not primarily directed to other parties such as regulators and members of the public other than investors, lenders, and other creditors. So these are the various limitations of general purpose financial reporting. So very easy, only thing is you need to listen carefully and also make note of the key terms, then everything's going to be easy for you. Moving on to the next, to be a perfectly faithful representation, financial statements depiction must contain various characteristics. Elaborate. So, what are the various things? Are complete, neutral, and free from error. So, complete is, it should include all the information necessary for a user to understand the phenomenon being depicted, including all description and explanations. Because what happens is the examiner, they will be having the key terms. So if you write merely complete, neutral, and free from error, you may not get the desired 4 marks or 5 marks. You will end up getting 1 or 2. So you are expected to reproduce these terms like descriptions and explanations and all those things. Moving on to the next, neutral. Neutral without bias is selection or presentation of financial information. A neutral depiction is not slanted, weighted, emphasized, de-emphasized, or otherwise manipulated to increase the probability that financial information will be received favorably or unfavorably by the users. And also neutrality is supported by exercise of prudence. These are the various things that gets fetches you extra marks, because prudence, it is prudence implies assets and incomes are not overstated and liabilities and expenses are not understated. Lastly, free from error. It means there are no errors or omissions in the description of phenomenon, and the process used to produce the reported information has been selected and applied with no errors in the process. So if you see neutral, free from error, the terms that is used frequently are selection and presentation. Whereas if you see in the previous question, the frequently used terms are existing and potential investors, lenders, and other creditors. This is what you should pay full attention on. So if you merely read from the book, these things won't get registered in your mind at all. So moving on to the next, how to enhance usefulness by applying the qualitative characteristics. The shortcut is cut verifiability. C is for comparability, U is for understandability, and T is for timeliness, and V is for verifiability. So comparability is neither same as consistency nor as uniformity. I repeat, comparability is neither same as consistency nor as uniformity. It refers to use of methods for same items, and uniformity implies that things must look alike and different things must look different. So this is regarding to comparability. Next is verifiability. It can be direct or indirect. It means different knowledgeable and independent observers could reach consensus, although not necessary complete agreement, that a particular depiction is a faithful representation. So this verifiability is very, very important. You should specifically mention it can be direct or indirect, because both kinds of verification is possible. Next is understandability. That is, financial information should be easily understandable. That is, For example, other income, other expenses, etc. The clarification, the clarity should be there, that is classifying characteristics and present information clearly and concisely to make it understandable. It should not confuse the investors, because the person reading the financial information may not be well versed with the annual reports and all those things. Timeliness means having information available to decision makers in time to be capable of influencing the decision. There's no point in giving the profit analysis all those things when they are not having the money in their bank account and all those things. So a complete picture is very, very important. So these are the various ways in which the usefulness of the financial information is enhanced by applying the qualitative characteristics. So moving on to the next. So this are the, I'll quickly summarize what of other past exam questions that was asked. So first is cost constraint on useful financial information. Both providers and useful users of financial information incur costs in reporting and analysis of financial information. ICA assesses whether benefits of reporting particular information are likely to justify the cost. That is, whether it should at least obtain the break-even incurred to provide and use that information. Next is explain criteria of conceptual framework for financial reporting for recognition of assets, and discuss whether there are in any inconsistencies with the criteria and India's 38. So in conceptual framework, probability criteria is not prescribed, whereas in India's 38, the criteria for classifying intangible assets is more specific. And also in January 26, limitation of accounting standards from first chapter was asked. So these are the various key things if you that has got a lot of chances, that is asked frequently in the exam. So first question we saw was limitation of general purpose financial reporting. Next is to be perfect or faithful representation, what are the various depiction that financial statements must contain. And next is how to enhance usefulness by applying the qualitative characteristics. Next is cost constraint on useful financial information. And next is criteria of conceptual framework, and also limitation of accounting standards. That was, so you can leave the last question. So I hope all of you found this video useful. Make full use of it. Keep going. Best wishes. And also ensure do subscribe so that all the exam related contents will be very handy for you. So watch this video at least 2 to 3 times, and also parallelly 1 or 2 questions that I may have missed out now. Ensure you cover them as well, so that you don't lose a single mark on question 5 and these topics as well. And also just want to add one more thing. Question 5 will be one question will be on Ind AS 115, then Ind AS 101, then this theory. So that is how the usual pattern of question 5 in your exams will be. So best wishes, keep going.